Michael Burry's persistent forecasts of coming economic calamity have prompted some to suggest that he was over the line into kid who cried wolf territory. In November 2021, Elon Musk referred to him as a broken clock. Nevertheless, Burry is not alone in forecasting further stock market declines. According to George Ball, chairman of Sanders Morris Harris, a Houston-based investment business with $4.9 billion in assets under management, the S&P 500 will fall below 3,100 this year, as the Federal Reserve raises interest rates in its fight against inflation. After a 20% drop from its January peak, the U.S. actually joined bear market territory in June. There is immediate conjecture throughout the world about whether this is the onset of a lengthy decline or just a hiccup before the stock market recovers. So, which one of them is it? Will the stock market rebound as we enter the second half of the year, or should we lock down the hatches and prepare for additional losses? What has the stock market done so far in 2022? Before we question when the stock market will return, we need to reflect on how we got here and remember a few facts. To begin, market volatility in all of its manifestations is a regular element of market activity. It's possible that this is the first time new investors have fallen from grace. Therefore, it's important to emphasize that this is nothing unusual. Ups and downs come in as many sizes as McDonald's beverages, and are the cost we pay for the long-term outperformance of corporate shares over cash. What is causing the stock market to fall? Sadly, equities are currently under attack from all sides, and the beverages cabinet behind this year's very awful market cocktail is stocked with bottles from all across the world. After COVID threatened to return, China was forced to close entire cities. Shenzhen, a significant finance and technology center with a population of more than 17.5 million people, became a ghost town suddenly when the country's zero-COVID policy went into force. Given China's centrality in manufacturing and global supply networks, in addition to its demand for commodities that fuel its massive facilities, the slowdown in its rebound has been noticed globally. China's ongoing lockdowns are a double burden for businesses already struggling to keep up with a post-pandemic demand increase. The issue was that they drastically reduced capacity during the pandemic and have considered it challenging to ramp back up to meet demand. All of this has contributed to a spike in inflation this year, adding gasoline to cost-cutting flames throughout the world. Increased interest rate projections, intended to keep inflation under control, are also boosting the number of analysts used to determine what corporations' future earnings are good enough to justify paying for today. Divided by a larger number, the result is lower, which indicates investors beginning to anticipate less, particularly from growing firms whose ultimate worth is yet unknown. As a result, high-value technology has taken a hit, and considering that the top brands accounted for about 25% of the U.S. market early this year, their death has affected the whole market. But we could be coming full circle. The markets currently appear to assume that Powell and his Federal Reserve bankers' actions will send the U.S. economy into a recession. In fact, many analysts believe the United States is already going through a recession. This might all be unfolding at the same moment as supply chains resuming normal operation. As a result, we may be in for a moment of lower demand caused by a recession and increased supply. As is typical, markets are forward-thinking and have included many of these concerns into stock pricing. What the market does not yet know is the impact that rising expenses and a potentially lower demand outlook will have on firm management's profit predictions for this year. So, while we've seen the first stage of a bear market, which is a drop in share prices indicating a decline in forthcoming profits, the present guessing game among analysts is the amount to which earnings will decrease for the remainder of the year. More information will be available when U.S. corporations announce second quarter profits and update the market on their current estimates for the rest of the year. How long would the stock market need to restore? It's tempting to go back in time and try to extrapolate what happened in prior bear markets to what's going on nowadays. We usually attempt to design connections for ourselves or hunt for existing ones to make us feel better when we don't have the responses. However, it's not the most ideal use of our effort because of the enormously wide range of factors impacting markets before, during, and after past crashes. So if you're searching for a stock market recovery time chart to follow like Jamie Oliver 30-minute dish, you won't find it. That's your fear speaking, not your calm. While history does not replicate itself, it frequently rhymes, and there are certain general lessons to be drawn from bear market scenarios. According to AP News, bear markets have taken an average of 13 months to rebound from their peaks, while stock market recoveries have taken an average of 27 months. That may appear to be a difficult path down and back to break even, but zoom out and there's cause to be optimistic. According to Hartford Funds, the average length of a bear market since 1929 is 289 days, or roughly 9.6 months. That's far less than the average length of a bull market, which is 991 days or 2.7 years. Furthermore, whereas equities lose 36% on average during a bad market, they gain an average of 114% during a bull market. The lesson here is that attempting to foresee these things with any degree of accuracy is a waste of time. Instead, as long-term investors, we must concentrate on the long term and avoid succumbing to short-term dread and gloom. When will the stock market rise again? Nobody sounds a bell at the market's top or bottom, and there's a reason why we should be fine with that ambiguity. It enables us to analyze firms on the ground and determine if the rest of the market is treating them equitably. If we all had an infallible magic 8-ball and could forecast when stock markets would return, what the trend would appear like, and which stocks would do well, we'd have a fully efficient market. There's no mispricing, no opportunities to buy equities for less than their true value, and no sense in active stock selecting. Volatility, as unpleasant as it might be, presents opportunities for us as investors. So while we're all waiting for the trigger that will propel us back up, we'd be better off focusing on the firms we believe are unfairly damaged by the greater gloom. History teaches us that this moment will pass, and it's pointless to hold your breath in order to breathe a sigh of relief when stocks have recovered. Perhaps this is a good opportunity to consider some recent high values in your portfolio. Were they justified, or did you succumb to the hype? Whatever you do at this time, make sure it helps you become a better investor with a stronger portfolio over time. What are some situations for recovery? It's worth considering the recovery ideas floated during the outbreak. The optimistic V-shape turned into a U-shape, which was followed by a likely W-shape, and the perplexing K-shape. We're still not entirely sure what that one meant. Every day, the alphabet soup of alternatives became larger. In reality, it meant that anything might occur. When you throw them all out there ahead of time, you can't really help but get one correct and pat yourself on the back. What with the broken clock and everything. So, while predicting any technical component of an eventual comeback is pointless, there are certain broad strokes that may help us get there. Few would disagree that the abolition, or as much as feasible, of COVID would boost markets. China's relaxation of travel quarantine regulations boosted the country's stock markets last week, and it's easy to imagine a final farewell doing the same for global markets. Crucially, any optimism would almost certainly reflect the bigger view of the world without COVID. That may sound apparent, but just throwing the virus behind us does not instantly fix disrupted supply chains, enterprises forced out of business as a result of the pandemic, and GDP growth concerns that are currently present. A halt to the crisis in Ukraine would also alleviate global fears. However, resolving the war would not be as simple as pressing the reset button. Russia's worldwide standing will be evaluated by the international community, and commodity-rich Ukraine will require billions of dollars to help reconstruct. There are no ready-made solutions here. In terms of economic problems, investors want to see inflation fall and interest rates remain stable. Realistically, if governments can get a grip on both, markets may respond positively at first. If inflation begins to fall and interest rates begin to fall, the discount rate will fall and values will rise. It's simple logic. When it comes to restoring investor confidence, the turning moment will most likely be when the market determines that values are excessively low, given the market's challenges. Problems do not have to go away. Markets only need to believe that the risks they bring are largely represented in share prices. It's a balancing act in this way, remarkably comparable to the classic risk versus reward precept we frequently discuss. Given that predicting whether or not any of this will happen is nearly impossible, it makes the argument for investing frequently throughout it. Waiting on the sidelines until everything is obvious may result in you missing the turnaround entirely.